Hello and welcome to PolicyCast. Today we are joined by Jatin Kalra, partner at Thornton Bharat, to decode the RBI's final directions on the expected credit loss framework and effective interest rate, a development that could significantly reshape how banks assess and manage credit risk. As India moves towards a more forward looking and risk sensitive provisioning regime, the shift raises important questions around implementation, profitability, and preparedness for financial institutions. Let's dive in. Jatin, to start with, how big a shift is this from the current provisioning norms? Are we looking at an incremental change, or is this a fundamental transformation in how banks think about credit risk?
Thanks, Shilpa. I think we can very confidently say that this probably is the biggest transformation that the banking sector has seen since the introduction of the prudential norms, which came in the 90s. And for the longest time, of course, banks were creating provisioning based on the rates which were given by the RBI. And now we have come to this new regulation wherein banks would have to determine provisions based on their own assessment of credit risk of the different type of portfolios and exposures that they have. So it's like, it's fundamentally a very different ball game that we are playing right now. Banks, of course, would need to not just differentiate between good quality customers, bad quality customers for the purpose of provisioning, but also keep tracking as the quality of these customers change over time. In case, for example, there are any macroeconomic events, there are any localized events which might be affecting credit quality of certain segments, certain customer class, then have to keep tracking that and adjusting provisions based on that. If I was to just try to give a metaphor in terms of how big that impact is, I would say that the earlier provisioning was how, the level of that was how mathematics is at, let's say, class 8 level, while ECL is something which you do at a PhD level. Like the amount of data science, analytics, predictive modeling that you have to do for this is like that kind of an upgrade is something that the banks need to do for provisioning right now.
Okay. So, against that backdrop, it's useful to examine how global frameworks approach this. Globally, we have seen frameworks like IFRS 9. How similar or different is RBI's approach compared to these?
RBI, I think, has stuck to their core objective of trying to align our ECL with the globally accepted ECL. I think that was very important. That's something which has been a call of different global stakeholders like World Bank, like even the G7 Council and credit rating agencies, that you should have globally consistent accounting standards so that, as we're looking at the integral world that we have right now, it's easy to, for business. So RBI has, I think, also had that objective to have their ECL regulations be in line with the global standards. But at the same time, I think they were a little worried around consistency and quality of the implementation, and that we could see in some of the you can say additional guidelines that RBI has put on the ECL framework. So ECL fundamentally is very principles based, right? They've retained that principle based thing, but they have added some rules in some places as additional safeguards or backstops, which I believe is there to help ensure that overall the industry remains resilient, remains conservative to the extent that RBI wants it to be. I think a primary example of this we can see with respect to the floors that RBI has introduced. So they have said that, okay, you go forward, calculate ECL for different product, different customers based on your own analysis. But at the same time, I am telling you that this should be the minimum ECL for, this product. This should be the minimum ECL for loan which is at this particular stage. And that is also something that you maintain. You make sure that floor is something which you achieve, and your ECL should not fall below that. So that is something which they have done. Apart from that, RBI has also given out certain governance related guidelines. So they have said that if you're using data, what kind of data should be used? How do you ensure it's of high quality? How do you ensure that it's not you're not getting some kind of a bias from the data which you're using. They've also kind of said no to certain practices which they believe could have resulted in some incorrect provisioning by some banks. So they've tried to adjust here and there, put in additional guardrails and all. But by and large, we can say that it is ECL is similar to what IFRS 9 ECL or globally accepted ECL practices are.
That's very well explained, Jatin. Now, one aspect that's getting a lot of attention is the potential flaw. How should banks think about the interaction between model driven ECL and this regulatory backstop?
Right. So that definitely is one of the most talked about things in ECL today. Since RBI came up with this thing that we'll have floors, there has been a lot of debate. A lot of industry participants have said that the floors being proposed by the RBI is a little high. We should look at lower floors specifically for stage 2, where the floors being suggested are at 5%, while currently the provisioning for them is at 40 basis points largely. So it is very well talked about, of course. It's being debated a lot. I think where RBI would have looked at it is, they would have considered that at different type of products and in different stages, what is it that they expect might be, the minimum provisioning that they believe would be appropriate. And with certain feedback which has come from the industry, they have adjusted those floors also somewhat. So, for example, they have lowered the floor on housing loan to retail customers. They have lowered the floor on exposures which are guaranteed by state government, for example. There's already lower floor for gold loans or loans which are backed by FDs. Some of these higher quality products, we have lower floors, which RBI has done just to ensure that we do not necessarily have excessive ECL provisioning. Having said that, we do expect that for some of the banks, for some of the portfolios, we'll see that the ECL being computed by their models would be lower than the floors, which means that because of the floor, they'll need to carry additional charge, additional hit to the capital. That's something which is now, a fact, which is a reality that's been reaffirmed by the RBI with the final regulations. Remains to be seen whether RBI looks at calibrating these flows as things move forward. There's something which is possible as, banks apply ECL, in some time with observed performance of different portfolio. Possibly RBI may look at recalibrating, but as things stands now, I think this is something which, even if it is as a conservative buffer, banks would have to prepare for as they're looking at hit to their capital on 1st April 27 and beyond.
Okay, understood. So let me now ask you, what is the business impact of all this? Because numbers eventually hit the P&L. And what kind of impact should institutions expect on provisioning levels and profitability?
Right. So the hit on capital, the hit on profitability is going to vary from bank to bank. The whole concept of ECL, of course, is that it's very dynamic. It's very sensitive to what's the quality of portfolio. And different banks, of course, have different type of product mix. Certain banks would have a lot more unsecured, let's say microfinance, retail kind of loans, on which naturally the risk level is relatively higher from, let's say compared to housing loans, or let's say certain kind of corporate loans to investment grade customers. So you do have differentiation in risk of the portfolio which different banks have, and that naturally is going to flow into what kind of ECL different banks would have to maintain for this purpose. I believe that more or less the impact which is expected based on my understanding and my work in this sector, for most of the banks it is going to be manageable. The hit on capital is something that people are, reasonably prepared for at this time. The recent years, of course, have helped strengthen the bank's balance sheet significantly, and the hit which is going to come because of ECL, whether it's going to be 30 basis points, 60, 90, or potentially beyond also, on capital, that kind of hit is something which most banks have kind of taken a rough estimate at least of, and have started preparing themselves for it. What's of course going to be interesting is that as 1st April 27 rolls in, how much is it that that one-time hit is going to be for banks? it is possible that some of the banks look at increasing their provisioning buffer through this time, through now till 1st April 27. There's of course 4 quarters of reporting which is still to go for that. During this period, they look at enhancing their provision such that the hit which comes because of ECL at that time is something which is already absorbed in some of the earlier periods. RBI, of course, has also said that you can spread out this hit from 1st April 27 through 31st March 2020, 2031, right? So there's this 4 period and time frame in which you can spread out this impact. Having said that, some banks may decide that, okay, it's probably, they would want to take the impact on one day itself. On 1st April 27, only take the whole impact and not make use of the glide path which is available from RBI perspective.
Given these implications, the obvious question now, Jatin, is how ready is the industry really? With implementation kicking in from 2027, do you think banks are largely prepared, or is there still a significant journey ahead?
Yeah, I think for most of the banks actually, there's a a long journey ahead and a relatively tough journey as well. While banks have been preparing for it, while banks have created some pro forma models and some the banks have implemented certain kind of models, with the final regulations coming in the form that they have, with the enhanced focus on a lot of governance, monitoring related elements, enhanced focus on automation, there is going to be a lot of work required from banks to achieve everything that's being asked for from them in the final regulations. The time actually is quite limited. There's hardly 11 months to go till the day when ECL becomes the reality for banks. And in this 11 months, there's honestly a lot for banks to do on the quality of data that's going into the models, the resilience of the models that they have, the policies, the framework, the systems and all. And also a lot to do with the documentation, getting things internally validated, approved, the 3 lines of defense, different committees. So it's honestly a lot of work that different functions of all the banks would need to do. So yeah, I think banks would really need to prepare themselves well for the journey ahead, make sure they have adequate resources allocated for this whole project, and plan in the way that they are able to achieve these timelines.
Yes, definitely. This brings me to my final question to you. Can you give just one piece of advice to institutions preparing for this transition? And if yes, then what would it be?
I think probably the most important thing for institutions would be in terms of how they are, designating responsibilities for the different elements of the ECL for different functions. ECL very much is a cross-functional exercise. You have of course the data teams who is going to provide a lot of data. You have the analytics team who are going to work on the models. You have the risk management working on the policies, the SICR, the EWS, all of that alignment. Then you have the finance team, which is going to play a role. The internal audit is going to play a role. The committees, the risk management committee, audit committee of the board, all of these different stakeholders are there within the bank who are going to be involved in this. How do you really orchestrate your program in a way that every stakeholder is involved, is responsible for the right elements, and they all work together? So managing that entire program is something which is going to be, I think, very critical, because sometimes what we have seen is in past implementation at some of the organizations that certain stakeholders do not get involved in the right way, and what that means is that there's an inconsistency between the quality of data or the ultimate work that happens. So I think it's very important to identify who is the right stakeholder for the right element and make sure they are involved at the right stage.
Thanks so much, Jatin, for breaking this down so clearly for our listeners. That was truly insightful. Many thanks to you, Jatin, for breaking this down, what is clearly a pivotal shift for the banking sector. As institutions prepare for this transition, the move towards a forward looking provisioning framework will not only impact financial reporting but also influence risk management and business strategy going forward. Thank you for joining us today, and many thanks to our listeners for tuning into this episode of PolicyCast. We will be back next week with more insights on the development shaping the world of business and policy.